Bismillahirrahmanirrahim. Assalamu alaikum. We will continue with our course, that is Investment and Portfolio Management, Mgt531. The reference book is the same as we discussed in the last lecture, that is by Christina, on investment analysis and portfolio management. First of all, we will discuss the summary of the last lecture. We discussed the financial markets in the previous lecture. We discussed the exchange, concept of exchange and characteristics and classification of exchange, the over-the-counter market, alternative trading system, and other characteristics of financial markets. We also discussed the money and capital market in the last lecture. Today's contents we will discuss the investment management process. That is, what is investment management process and why it is needed, that is, we can say, what is the requirement of this as far as the investment is concerned for the portfolio holdings. Investment management process is the process with the help of which we manage our funds in order to undertake our investment. Or the investors, they arrange to manage their funds and finances to undertake their investment and to make purchases for different instruments in their portfolio holdings. And therefore, they will have to have the decision that how they can arrange their funds, how they can manage their funds. Investment, as we discussed in the last lecture, investment management process comprises of 5 different procedures, and these and we have different stages over here. What are these stages? The first stage is setting of investment policy. That is, we have to set up an investment policy as far as in the investment management process. Second category is analysis and evaluation of investment vehicles. Third is formation of diversified investment portfolio. Then fourth is portfolio revision. Fifth important stage is measurement and evaluation of portfolio performance. Globalization of financial markets. Here we have the concept of globalization of financial markets. Globalization and integration process include the integration of financial markets into an international financial market. In other words, we can say that if we have globalized financial market, we can interact at the international level with the other actors and with the other participants of the financial market, and we can take benefit from the functioning and trade taking place in the international market. Because another important reason is that because the globalization of financial market, potential issuers and investors in any country become not limited to their domestic financial market. But the important advantage of globalization of financial market is that those who are issuing the financial certificates and securities, and those who are investing in them, they are no more limited to their country and to their domestic boundaries, but they come up at the international level, and they have interaction and trade at the international level with the international trading agents. The first important is the concept is setting of investment policy as far as the stages of the investment management process are concerned. Setting of investment policy is the first and very important step in investment management process. That is, we have to manage our investment policy first of all in order to continue the process of our investment. Investment policy includes setting of investment objectives. We have to set up of investment objectives, that is what is our policy and why we formulate the policy. We formulate the policy for the investment, that we set up our objectives of the investment, that what is our aim to undertake investment. The investment policy should have the specific objectives regarding the investment return, requirement and risk tolerance of the investors. What is the specific objective of investment policy? That is, we have the idea, we have the knowledge of returns of the investment. That is, what should be the returns as far as the investor is concerned, and what should be the level of the tolerance of the risk for the investor. All these points should be discussed and should be settled down in the investment policy. First is the objective. What is our objective to formulate any investment policy in order to undertake the investment? And secondly, we can say that we have to analyze the returns of the investment, what we will be able to get out of our investment, and what can be the likely risk associated with it. And the risk tolerance of the investor should be analyzed with this. For example, we can say that investment policy may define that the target of the investment average return should be 15%. For example, we can say that this means कि जो investment policy हम formulate करते हैं उसमें हमें investment returns का एक target set करना चाहिए. That is, for example, हमने ये set किया है कि investment average return जो है they should be at least 15%. और हमने secondly we settle down another point कि जो loss है they should not exceed than 10%. कि losses should not be more than 10% and this risk जो return है should not be less than 15%. So we have to identify the investor's tolerance for risk. This is important objective of the and this should be important objective of the investment policy, that what is the investor's tolerance level. वो कितना bear कर सकता है risk को, उसका behavior क्या है as far as risk is concerned. Because it is obvious that every investor would like to earn the highest return possible. क्योंकि ये जो objective, जब हम objective settle down करते हैं, we should come to know, because the objective of the investor, the aim of the investor is to have maximum return out of the investment. Therefore, we know that every investor will like to have maximum returns and highest possible returns. तो जो investor tolerance level है, it should be clarified, it should be identified कि उसका tolerance level as far as risk is concerned क्या है. उसको risk, कौन सा risk का level जो है वो affect करता है. Whether he is risk loving, वो he likes to have the risk, या वो risk neutral है, उसको he is indifferent to the risk, या फिर he is risk avoider कि he wants to avoid the risk and prevent the risk. वो risk नहीं चाहता, he wants the minimum risk with the maximum benefit. We should highlight all these things in when we set down our objectives in the investment policy. Because there is a positive relationship between the risk and return, it is not appropriate for an investor to set his or her investment objective just as to make a lot of money. Therefore, we can say when we are deciding about when we are setting down and highlighting the level of risk tolerance of any investor, we should clarify this point that there is positive relationship between the return and risk. Whenever there is increase in the level of return, there will be increase in the level of risk. They are positively associated with each other. Every investor should keep in mind it is not possible to have a lot of money, to earn a lot of money out of any investment, out of any project with the minimum level of risk. Therefore, we can say whenever there is a level of risk return, there should be positive level of return, and the investor should clarify this point, should highlight this point as while setting out his objective in his investment policy. Therefore, investment objectives should be stated in terms of both risk and return. So we can say that investment objective, they cannot be independent of the risk and return. Both risk and return, they go side by side. There is positive relationship between the two. अगर हमारा level of risk, if we think that return they lie on the horizontal axis and we think that risk lies on the vertical axis, there will be positive relationship between the two. Both will increase. When there is increase in the level of return, there will be increase in the level of risk as well. Investment objectives should be stated in terms of both risk and return at the same time. Therefore, we cannot avoid risk when we have the wish, when we want to and we intend to earn maximum level of return. Therefore, the investment policy should state other important constraints which could influence the investment management. because we are discussing the investment management process, that while managing the investment, what is the whole process through which process we can manage our investment. Then investment policy should include that there may be other constraints which can influence the investment management. What are these constraints? These constraints include any liquidity need for investor during the projected time investment horizon, as well as other unique needs and preferences of the investors. Another constraint, important constraint beside the level of risk, is that liquidity needs of the investor. While highlighting the objective and the investment policy, the investor should make clarified that what is his level of liquidity need during the specific time period of his investment project, during the investment time horizon, and what can be the other preferences of the investor during that investment that the investor is deciding to make and the investor is going to invest. Once he or she has decided to purchase certain instrument and keep certain instrument in his portfolio holdings, during that the level of liquidity needs do not change, and the investor should take care of the time horizon of the investment, and the investor will not be likely to change his preferences. So what is the investment time horizon for the investors? Investment time horizon for the investor is the period of time for which investment takes place, or investment is considered or is undertaken. Projected time horizon may be short, long, or even indefinite. So we can say that investment time horizon may be different depending upon the level of the project. For example, we can say that the investment time horizon, it may be short, it may be long, or it may be indefinite. That is, it may comprise of long time period. Therefore, it is the investor should, while setting out his objectives in the investment policy, he should make clear or highlight that there should be no further changes during the investment time horizon. Once the investment is undertaken, he or she should not change his preferences. Setting of investment objectives for individual investors is based on assessment of their current and future financial objectives. When the investor is setting out his investment objective, he should assess the current and future financial objective. That is, what are the investor's objectives at current time and for the future time period when he is going to settle down his investment objective. और उसको अपने फाइनेंशियल जो नीड्स हैं उनको after settle down the objectives and after settle down the investment, he or she should not change his financial preferences neither during the current time period nor for the future time period. The required rate of return for investment depends on what sum today can be invested and how much investor needs to have at the end of the investment horizon. Therefore, he can get the maximum possible amount, maximum possible returns out of his investment if we go through these lines, which we are going to discuss. If the investor go through these lines, then once settle down the objectives of the investment, he or she should not change his preferences as far as liquidity is concerned, as far as the time horizon is concerned, as far as the other preferences are concerned. That is, there should be no fluctuations in the need for the cash during the investment period once the investment is undertaken, and there should be no change in the time horizon, because once the time is settled down, there will be no further change in the investment time period, and there should be no changes in the preferences of the investors once the preferences are settled down. Therefore, if the investor is likely to do all these things, he will be able to extract maximum benefit out of his investment, and his rate of return definitely with respect to investment depends upon what is the amount of investment, how much he has invested is the first thing. Second thing is that what he can get at the end, what he is going to get at the end, and all this depends upon definitely on the environment of the investment and on the management process. Wishing to earn higher income on his or her investment, investor must assess the level of risk he should take and to decide if it is relevant for him or not. When investors decide to earn, when investor intends to earn and wish to earn higher level of income out of his investment, he must assess and evaluate the situation as far as level of risk is concerned. He must think about the risk level that he has to bear the level of risk while he is going to make or undertake any investment. Therefore, he or she should undertake the investment accordingly by keeping both concepts, return as well as risk, together. That is, he cannot avoid risk while undertaking the investment for having high returns. And another important point for the investment policy is that investment policy can include the tax status of the investor. That is, the tax policy should include the investment policy should include the tax status of the investor, that what is the level of the wealth, what is the level of the project, that is what is the level of investment he is going to invest, and he and she will definitely pay the tax to the government, and tax cannot be avoided, and the tax money will be deducted and will be paid to the government account. Therefore, the investor should keep all these points in mind before going to undertake any investment, so that he or she should have the idea of returns he is going to have at the end of the project or after the maturity of his investment. This stage of investment, at this stage of investment management, we conclude with the identification of potential categories of financial assets for inclusion in the portfolio. The important to know is that he should identify the instruments which can be included in his portfolio holdings. The identification of potential categories is based on different points. That is, we can say that when he is going to identify the tools, when he is going to identify the instruments and different entities which he is going to include and which he is going to purchase for his portfolio holdings, he must take into account few things. The first is investment objective. We should identify our investment objective, that what is our investment objective, how much we are going to we want to get out of our investment. Definitely what we are going we would like to get out of our investment should be linked with the level of investment. Okay, what we are going to invest in our project, what is the level of investment, what is the plant and scale of the investment. This is also important while settling down our objectives of investment. Third important is the time period for which investment is going to be made. कितने टाइम पीरियड के लिए हम इन्वेस्टमेंट जो है वो लगा रहे हैं, ये हमारा शॉर्ट टाइम पीरियड है, मॉडरेट टाइम पीरियड है या लॉन्ग टाइम पीरियड है. और टैक्स स्टेटस ऑफ द इन्वेस्टर इज ऑल्सो इम्पॉर्टेंट कि ही मे बी his income may be taxed or will definitely be taxed if he has a good status, financial status. And keeping all these points in view, we should settle down our investment policy while going through the investment management process. Analysis and evaluation of investment vehicle. Okay, we have second important point is that after the settlement of investment policy, we should analyze and evaluate the investment vehicle. What type of investment vehicles can be included in our portfolio depending upon the environment of the financial market and current situation prevailing in the financial market, depending upon the experience of the other people, depending upon the behavior of the investor. We should clearly analyze all these things, and we should evaluate all these the plus points and minus points of the investment vehicles. When the investment policy is set up, the investor's objective defined and investors' objectives are defined, and the potential categories of financial assets for inclusion in the investment portfolio are identified. The available investment types can be analyzed. we mean to say here is that once the policy is decided, once the objectives are defined, that what are the objectives, what type of investment individual is going to invest, and what are the potential categories of financial assets which is he is going to include in his portfolio holdings. That is, we can say, when we have identified, or the investor has identified his items of portfolio holdings, the investment types can be analyzed and can be evaluated. This analysis and evaluation of investment vehicles involves examining several relevant types of investment vehicles and the individual vehicles inside these groups. That is, the individual investor should examine all these different types of investment vehicles very carefully. That is, the plus and minus points of the investment vehicles and the plus and minus situation of the financial market concerned with the investment vehicles. In other words, we can say that the individual investor should analyze the behavior of investment vehicle for some time period in order to make his own decision for the investment. For example, if the common stock was identified as investment vehicle relevant for the investor, the analysis will be concentrated to the common stock as a investment. यानी कि अगर when we are going to analyze the positive point and negative point, or in other words we can say the benefits from any investment and investment in any item, or negative point are the losses from investment in any vehicle or tool, we should concentrate on that. We should analyze the behavior of the asset. मिसाल के तौर पे अगर हम ये आइडेंटिफाई करते हैं कि वी शुड इन्वेस्ट या शुड इन्वेस्ट इन कॉमन स्टॉक, तो फिर इन्वेस्टर जो है वो कॉमन स्टॉक को एनालाइज करेगा and will analyze the behavior and attitude of this particular stock after over some time period कि स्टॉक की प्राइस क्या रही है, इसकी बाइंग प्राइस क्या रही है, फॉर सम टाइम पीरियड इसकी सेलिंग प्राइस क्या रही है, इसने कितना अपवर्ड फ्लक्चुएट किया है, कितनी सडन फ्लक्चुएशंस आई हैं, कितना इसकी प्राइस वॉलेटाइल रही है, मार्केट कितनी फॉर दिस पर्टिकुलर एसेट जो स्टेबल रही है, कितनी अनस्टेबल रही है. The investor will have to analyze the behavior of this particular stock rather than कि वो उस stock को analyze करे या उस stock का behavior analyze करे जिसमें वो interested नहीं है, जिसको वो he or she is not willing to keep in his portfolio holding. So rather than wasting the time to analyze and look around, he or she once decided to keep one stock should analyze the behavior of that particular stock. The one purpose of such analysis and evaluation is to identify those investment vehicles that currently appears to be mispriced. Then we move. There are many different approaches how to make such analysis. We can analyze, we can observe and look at the different approaches with the help of which we can undertake this analysis. That is, we can analyze and evaluate the behavior of different investment vehicles. Most frequently, we have two forms of analysis, which are usually used in order to analyze the behavior of different investment vehicles in order to evaluate the behavior of different investment vehicles. First type of the analysis is technical analysis, and the second type of analysis is known as fundamental analysis. What are these analyses? Technical analysis involves the analysis of market prices in an attempt to predict future price movement for the particular financial asset traded on the market. What technical analysis tells us, technical type of analytical method tells us that the market prices should be analyzed carefully for this particular investment vehicle. That is, the investor should try to find out what the future flow of prices will be for this particular investment vehicle. That is, in the future time period, what type of price and what will be the line of price fluctuations for this particular vehicle investment. This analysis examines the trends of historical prices and is based on the assumption that these trends or patterns repeat themselves in future. टेक्निकल एनालिसिस ये है कि जब हम टेक्निकली किसी इन्वेस्टमेंट का या किसी इंस्ट्रूमेंट का बिहेवियर एनालाइज करते हैं, वी हैव टू लुक एट द पास्ट ऑल्सो. फॉर एग्जाम्पल, अगर हम कहते हैं कि दिस इज टाइम पीरियड लेट्स से 2010 और नेक्स्ट इज द टाइम पीरियड 2012 and then we have 2014, we have to analyze the behavior of the prices of this particular asset over this time period, over the past time period and over the future time period. For example, 2015, and we see that on the vertical axis we have the price of the investment. Price of the investment tells us that what is the trend that this particular vehicle is following. For example, if we observe the volatility here, we up and down fluctuations we are observing in the price of this asset. And at 14 we see that the price is again fluctuating, and we predict, we try to predict the future time period price. Okay, what will be the price of this particular vehicle in future time period? We will have to analyze, and we should analyze the price of this particular vehicle in the past time period. Or in other words, we can say that we should have to analyze the history of this asset. We should have to analyze the history of this particular asset. Or through analyzing the history of this asset, we can come to know that what line of the value this asset is going to follow in future time period. This is technical method to analyze the value of market value of any asset and to predict the future price movements of any particular financial asset which is being traded on the market, so that this will provide the guideline for the investor to invest in this particular asset or to purchase this particular asset, and in what quantity to make the purchase. Then second type is fundamental analysis. Fundamental analysis is its simplest form is focused on the evaluation of intrinsic value of the financial asset. Okay, what is the intrinsic value of financial asset? We can say that we have two types of basically values of any asset. One is the apparent value, जिसको हम प्राइस वैल्यू कहते हैं, जो कि मार्केट प्राइस है, और मार्केट प्राइस इज बेसिकली मेजर टू इंडिकेट द इंट्रिंसिक वैल्यू. Intrinsic value indicate the value within the asset which is hidden within the asset, or in other words we can say due to which the investor is likely to invest in this particular asset. What is the reason due to which this particular asset is going to be preferred by any investor, or that is the intrinsic value of the financial asset. This valuation is based on the assumption that intrinsic value is the present value of future flows from particular investment. और ये जो intrinsic value है, ये present value को भी indicate करती है और and indicates the worth of this particular asset in the future time period. Definitely, if any asset is worthy in the present time period, it will be worthy, it will be valuable in the future time period as well. By the comparison of the intrinsic value and market value of financial assets, those which are under period which are underpriced or overpriced can be identified. It tells us that we have two important values. One is the market price of any asset, and other is the intrinsic value of any asset. Market prices which is being used are the measure at which we trade in the market for that particular asset. Intrinsic value indicates the intrinsic worth of that particular asset. If the asset is worthy at present time period, it will be worthy and valuable in the future time period. Also, if due to its intrinsic worth we are likely to purchase it now, definitely we are purchasing it now that it will benefit us in the future time period. Or intrinsic worth can also indicate the worth in the sense that the asset is underpriced or it is overpriced. कि जो एसेट है इसकी नॉर्मल लेवल से कम प्राइस इंडिकेट की जा रही है मार्केट में, जो इसकी प्राइस का मैयर है, इसकी वैल्यू का मैयर है, वो इसकी इंट्रिंसिक वर्थ से कम है या ज़्यादा है। इन सिंपल वर्ड्स वी कैन से कि जिस एसेट की जो वैल्यू है, वेदर इट इज बीइंग परचेज्ड एंड सोल्ड एट लेस प्राइस और बीइंग परचेज्ड एंड सोल्ड एट हायर प्राइस। फॉर एग्जाम्पल, इफ वी टेक द एग्जाम्पल ऑफ द oil is definitely precious for us because it is not our commodity and we import it, or it is needed in all very much in the economy for the function of the economy to take place. Production के लिए जो है oil is needed very much, और oil की price जो है, और we come to know कि the market price of the oil is high, ये ज़्यादा है in our economy, और definitely it is due to the intrinsic worth of the oil because it has intrinsic value for our economy because our production is based on the oil, and oil is an important ingredient, it is an important component in the production function of our economy. Therefore we think that it is very important for us to look at the intrinsic worth and the market worth of the value of the oil. This step involves identifying those specific financial assets in which investment and determining the proportion of the financial assets in the portfolio take place. Or market value, and with the help of analysis of market value of financial assets and intrinsic value of financial assets, we will be able to determine the items, we will be able to determine the assets and the instruments which we can keep and we should keep in our portfolio holdings, and which can be the part of our portfolio holdings. Formation of another is important point is formation of diversified investment portfolio. This is the next step in investment portfolio management process. So we can say that formulation of and decision of diversified investment portfolio is the next step in our investment management process. We can say that our investment portfolio holding should be diversified. The set of investment portfolio should not show consistent behavior of the investor for a long time period. However, we should have diversification in our investment portfolio holdings so that we can increase, we can have the fluctuations or changes in it if we are going to have loss from keeping one type of assets, and we can have benefit from keeping other type of assets in our portfolio. For example, if the price of one asset is going down in the market and we have diversified investment portfolio holdings, so we can benefit from some other type of investment portfolio holdings, so and that will manage our overall value and overall benefit of our investment holdings. Investment portfolio is the set of investment vehicles formed by investors seeking to realize its defined investment objectives. Investment portfolio basically indicates the investment objectives of the individual, that what type of assets he is going to purchase in his portfolio holdings, and what he is going to decide about his set of portfolio holdings, and what is the quantity of assets, different items, different assets which he is going to purchase for his portfolio holdings. In the stage of portfolio formation, here we are discussing the portfolio formation and the formation of diversified investment portfolio. In the stage of portfolio formation, the issue of selectivity is important. What is the issue of selectivity? The issue of selectivity is basically linked with the selection of different items in our portfolio. That is, the investor should be clear and should have identified situation as far as the purchase of different items and selection of different items in his portfolio is concerned. Second is the timing. That what should be the timing for purchase of and for the selection of any portfolio. किस टाइम के ऊपर उसको कौन कौन से जो इश्यूज या कौन कौन सी सिक्योरिटीज को परचेज करना चाहिए, कितनी क्वांटिटी में करना चाहिए, एंड टाइम एट व्हाट टाइम. Why timing is important? Timing is important because at some time we have high prices of any assets, and the other time we have lower prices of any asset. If we purchase, as we discussed earlier, if we purchase any item, any asset at high prices, and afterwards if the prices go down, so we should not decide to sell at the lower price because it will create a loss for us. Rather, we should decide that if the price is low, we should try to purchase that asset at the low price, and when the price go up, we should try to sell that asset. So timing is very important as far as the purchases and sale of the portfolio holding assets is concerned. Third important point is diversification need to be addressed by the investor. That is, he should have diversification. The investor should have diversification. He should pay attention to diversified portfolio holdings rather than to have consistent behavior about the selection of items, about the selection of different tools and instruments in his portfolio holdings. That is very much important in order to have maximum benefit for the portfolio holdings at the time of the sale. Or if he is going to have consistent behavior for the selection of the items in his portfolio, or it is quite possible he is keeping only one item, only one instrument in his portfolio holding, and the price of that, if the price of that instrument falls after some time period, and he has purchased the 5,000 units of that particular asset, so definitely when the price of one unit falls, it will be applicable to all units purchased, and the investor will have to bear a huge loss in this respect. Therefore, we can say to have efficient objective, in order to have efficient decision as far as the portfolio holding is concerned, he will have to bear all these points. In the stage of portfolio formation, the issue of the selectivity, the timings and diversification needs to be addressed by the investor carefully. That is, in order to have efficient outcomes of the investment, he will have to take into point all these points carefully and should not ignore any of these points. Selectivity, the first important point while forming the portfolio is selectivity. Selectivity refers to the micro forecasting and focus on the forecasting price movement of individual assets. So we can say that selectivity is too much important as far as the purchase of and selection of the assets is concerned. On the basis of this, the individual will be able to forecast the future worth of the asset, will be able to predict the future prices and the movements in the prices of the particular asset in the future time period. Then timing is important. Timing involves macro forecasting of the price movement of particular type of financial asset relative to fixed income securities in general. Therefore, we can say that timing is also important, as we discussed earlier, that during the formation of the portfolio holdings and the selection of the items of the portfolio, the investor should take into account the timings of this investment, because he can analyze the behavior of the asset and behavior of the movement in the prices with respect to time. Third, diversification involves forming the investor portfolio for decreasing or limiting risk of investment. That is, as we discussed earlier, that if he has he invests in the diversified investment portfolio, and if the price of the one type of assets falls, it is quite possible that the price of the other types of assets in his portfolio may increase, and he may be likely to earn a maximum benefit out of the other assets. फॉर एग्जाम्पल वी एज्यूम डेट अगर इंडिविजुअल ने अपने पोर्टफोलियो होल्डिंग्स में एक तरफ तो उसने जो है वो शेयर्स रखे हैं फर्टिलाइज़र के, लेट्स से, और दूसरी तरफ उसने ऑयल रखे हैं. अगर फर्टिलाइज़र के शेयर्स जो है उनकी प्राइस कम हो जाती है और ही थिंक्स ही इज़ गोइंग टू हैव ए ग्रेट लॉस बाय द परचेज ऑफ दोज शेयर्स ऑफ फर्टिलाइज़र, or he is having second item in his portfolio जिसको हम कहते हैं oil, or price of the oil if it is increasing, if price of the oil is increasing and is showing positive trends, so it is quite possible that he may earn a lot, he may earn a handsome amount by the sale of the units of oil, and by the sale of the sale of the shares of the oil, and we can say that he will be able to manage his overall investment, and the benefit of he will be able to have overall benefit of his investment, and he will not be desperate out of the declining prices in the first type of instrument which we discussed is the fertilizer. There are two techniques for diversification. What is diversification? We have the random type of diversification on one hand, and we have objective type of diversification on the other hand. What is random diversification? When several available financial assets are put to portfolio at random. So we can say when we randomly select the portfolio holdings, or we randomly select the instruments involved, or the items included in our portfolio holdings, is known as random diversification. Second, objective diversification. When financial assets are selected to the portfolio holdings for the following investment objectives. First of all, we have to take into account the objectives of the investment. Why we are investing? हमारा objective क्या है investment का? Using the appropriate technique for analysis and evaluation of each financial asset. This basically tells us that at random, on one hand, at random, we can select our items of investment portfolio holdings, that is known as random diversification. Second, the objective diversification. जब objective diversification की हम बात करते हैं तो we have to take into account the objectives of the investment, कि हमारी investment का objective क्या है, कि हमने कहाँ इन्वेस्ट करना है, कौन कौन से हमने एसेट परचेज करने हैं, कौन कौन से हमने आइटम्स we want to keep, which items in our portfolio holdings, or in what quantity we want to keep in our portfolio holdings, or what are the logics behind the selection of those particular assets. उन particular assets की selection के या उनकी purchase के behind what is the reason why we are selecting those particular assets in our portfolio holdings. So this is the known as objective diversification of portfolio holding. Investment management theory is focused on issue of objective portfolio diversification. We are discussing, since we are discussing the investment management process, according to investment management theory, the objective portfolio diversification is important to be analyzed. Okay, first of all, we have to, rather than selecting the portfolio holding at random diversification, we have randomly selected. We should look at we should analyze and we should look at the objective of our investment, कि हमारी investment का objective क्या है, हमने कौन कौन से items जो हैं वो purchase करने हैं, what should be the types of items in our portfolio holdings, and what should be the quantity of each item which we are purchasing for our portfolio holdings, or why we should analyze the prices and fluctuation in the prices of those items. In other words, we can say that we should analyze the price behavior of those items that we are going to purchase for our portfolio holdings, rather than purchasing the items at random, कि हम randomly उनको select कर लें. This is basically the objective or discussion according to the investment management theory, which is considered important. Professional investors, they follow settled investment objectives, then constructing and managing their portfolio. तो जो है that is according to investment management theory, professional investors they would prefer to decide their portfolio holdings or set up portfolio holdings on the basis of their objectives of investment. That is, they define their definite and their particular objectives of investment, and they identify the logics behind that investment, and then they formulate their portfolio holdings set. rather than looking at the things, and rather than buying the titles and instruments of the portfolio holdings at random. Portfolio. Then we have the concept of portfolio revision. The next important stage is portfolio revision. This step of the investment management process concerns the periodic revision of three previous stages. This is necessary because over time investor with long-term investment horizon may change his or her investment objective, and this in turn means that currently held investor portfolio may no longer be optimal and even contradict with the new settled investment objective. So why this stage of investment management process is important? The portfolio revision is important because it is quite possible that we undertake the long-term investment projects, or in the long-term investment projects definitely the time horizon is high, or on the course of the investment it is quite possible that we come to know that this may not be a much more beneficial investment. This particular instrument or this particular tool or the type that we are type of item that we are going to we have kept in our portfolio holding is not good or not much beneficial for us. So we may revise our portfolio holding, and or it is quite possible that on the course of the investment we may contradict our initial or our first objective or our first thinking about any particular investment instrument, and on the course of the investment it is quite possible that we may contradict and we may oppose the original view of any particular item that we have kept in our investment portfolio. Therefore, we can say that the portfolio revision this stage of portfolio revision of formation of portfolio holding is important in order to have efficient set of portfolio holding items. Investors should form the new portfolio. So what happens through the portfolio revision on the course of formation of portfolio holding? What happens that investors should form the new portfolio. उसको नया portfolio बना लेना चाहिए rather than sticking with the initial portfolio, क्योंकि it is quite possible कि अब वो अपने उसकी जो सोच है बदल गई हो with respect to any particular instrument or tool which he is going to keep in his portfolio. और वो जब नया portfolio बनाता है तो by selling some assets in his portfolio वो कुछ assets अपने portfolio से sell कर देता है और कुछ new assets जो होते हैं वो उनको buy कर लेता है that are not currently being present in his portfolio. So how he can formulate, we can say through this portfolio revision stage of portfolio formation, how he undertake the revisions or how he formulate new portfolio, that is he sells some of assets, some units of the assets he has included in his portfolio, और कुछ new assets जो होते हैं उनको purchase कर लेता है, some units of the new assets जिनको that are not already included in his portfolio may be included now and maybe bought now, and he thinks that now this new portfolio holding is much more beneficial for him and is much more efficient for him and indicates his efficient decision. It could be the other reason for revising a given portfolio over the time. The prices of the assets change, meaning that some assets that were attractive at one time may be no longer to do so. Thus investors should sell one set and buy the other more attractive in this time according to his or her evaluation. So we can say that through observing or looking at the prices and the price behavior of the assets, he can change his portfolio. He can reformulate his portfolio. He may include some more attractive items in his portfolio and may sell some portion of the assets which are not much more attractive, and on the basis of the evaluation of the investor. The decision to perform changes in revising portfolio depend upon other things in the transaction cost incurred in making these changes. Definitely when he is revising, we can say that when he is deciding to revise his portfolio, he has to, other things being equal, he has to undertake some transaction cost. Definitely he or she has to undertake the cost. He has to bear the cost in terms of time, he has to bear the cost in terms of the mental engagement, he has to bear the cost in terms of money while revising his portfolio set. For institutional investor, this we were discussing about the individual investor. Now for institutional investors, portfolio revision is continuous process and very important part of their activity. So we can say that institutional investor, they like the portfolio revision, and they undertake it as a continuous process, and this is important part of their activity. They like to revise their portfolio, and on the course of the portfolio holdings, they sometimes come to know that they have to reformulate their portfolio holdings, and they should change their portfolio holdings. And what they do at the end, that they include some new assets in their portfolio holdings, and they exclude some part of the already existing portfolio by selling some portion of the existing assets in their portfolio, and in this way they can change and they can reformulate their portfolio holdings. But what the individual investor do, they manage portfolio. Individual investors, they managing portfolio must perform portfolio revision periodically as well. However, the individual investor, they revise their portfolio after some time period and periodically. That is, they do not do this this process, or they do not continue this behavior frequently during the course of portfolio holdings, because they are single investors and they are relatively much more risk averse rather than the institutional investor, because the institutional investor, they are working in a group, and they would be more like to revise their investors, and there are the many shareholders in their portfolio holding. Therefore the risk may be divided, rather than with the individual investor the risk will be wholly and solely bear by that individual investors. He will be little bit more careful while revising his portfolio, and periodically will revise his portfolio by carefully analyzing the behavior of the prices and trends of fluctuation of the prices of the assets over the time. Both they will analyze the past behavior, current behavior, and they will try to look at the future behavior of the prices of any particular asset. Periodic re-evaluation of the investment objectives and portfolio based on them is necessary, because financial markets change, tax laws and security regulations change, and other events alter stated investment goals. How the periodic re-evaluation of the investment objectives and portfolio is changed, and on what things this re-evaluation is based, it depends upon the financial market changes, that is the changes in the financial market situation, and the changes in the tax law by the government, and changes in the security regulations, and other economic changes or the political changes may lead to the changes and may guide the individual investor to change their objectives and to reformulate their portfolio holdings and to bring the formation in their portfolio holdings, so that they can have maximum benefit at the end of the investment with the minimum cost, and therefore they will be able to satisfy with their investment, and this will definitely help them to further invest in these particular items for their portfolio in the future time period. Then we have measurement and evaluation of the portfolio performance. The last step in the investment management process involves the determining periodically how the portfolio performed in terms of not only the returns but also the risk of the portfolio. Therefore, we can say that while managing the investment process, the investor should take into account the returns earned as well as the risk of the portfolio. That is, they should highlight, they should identify they should identify while formulating their objectives that what can be the possible returns out of their investment, and what can be the possible level of risk while holding this particular type of portfolio. That is, there should be no ignorance as far as the returns and risk are concerned, so that so that individual will be able to able to make clear objectives while deciding about the items being kept in his portfolio holdings. For evaluation of the portfolio performance, appropriate measure of return and risk and benchmark are needed. So we can say that in order to evaluate the level of return and level of risk while deciding to have the portfolio holdings, through the evaluation of portfolio performance, we should need a benchmark, and a benchmark is basically the performance of the predetermined set of assets obtained for comparison purpose. The benchmark may be appropriate index of appropriate assets and stock index and bond index. Therefore, what are the benchmarks and why we need the benchmark? Basically, we need the benchmark to analyze the performance of portfolio items. That what the portfolio items, in what direction they have flowed, in what direction, and what was the behavior of the prices of any particular item in the portfolio. We need a benchmark with the help of which we can compare the return and risk of any particular item that is kept in our portfolio holding. And what are these benchmarks? These may be the index, and we formulate the index. For example, the bond index and stock index, which can guide us that in which direction the overall performance of the financial market has gone, and in what direction the overall performance of the any particular items or any particular asset is gone. These benchmarks are widely used by institutional investors evaluating the performance of their portfolio. Therefore, these are important. It is important to point out that investment management process is continuing process and influenced by changes in investment environment and changes in investors' attitude as well. Therefore, we can say that investment management process involves the environment of financial market, it involves the economic environment of the society and country, it involves the political environment, that is while settle down our objective, and when investor is trying to highlight his objective truth on the investment management process, the fluctuations in the economic situation and political situations may influence the overall behavior and trend of the prices of the assets, and may affect the attitude of the individual investor to decide upon the choice of any particular items or titles being kept in his portfolio holdings. Therefore, we can say that attitude of the individual investor as well as the environment, they both affect the choice of the portfolio holdings on the investment management process. So market globalization offers investors new possibilities. That is, as far as the internal market is concerned, we should be clear about our objectives to be kept in our portfolio, and we should clear about the prices of the price behavior of the different items to be kept in the portfolio, and across the border we should also so we can have the new possibilities, and we can have the new ways to undertake our investment, and we can keep new items in our investment portfolio holdings. Therefore, beyond the boundaries of our country, at the international level, in the international market, we can be aware of the other items, we can be aware of the other instruments that we can choose to keep in our portfolio holding. Today's lecture is finished with this. And at the end of this topic, I will go to summarize the whole process, that what we did today. We discussed the investment management process. Today's lecture comprises of the situation concerned with the investment management process, and through which we can manage our funds, we can highlight and identify our objective of investment. And the one important thing we discussed is that while settling down our objective, we should have a complete investment policy that we should identify our objectives of investment with the help of the investment behavior and changes in the prices of the particular items, price fluctuations in the prices of particular items of the portfolio holdings, and we should analyze and evaluate the behavior of investment vehicles, and we should also try to and take interest to have diversified investment portfolio, and we can have the revision in our portfolio and can formulate new portfolio on the process if we feel any changes in the economic environment, or if we feel any changes in the political environment of the country. And beyond, we can feel certain constraints in our while choosing our portfolio holdings and deciding about the items in our portfolio holdings, and beside working on our beside taking interest to invest in the items and the instruments in our national and internal market, we should also take interest across the border at the international financial market, and we should purchase the items at the international level to make our portfolio holding set proper. That's it. Thank you so much. Inshallah, we will continue in our next lecture. Allah Hafiz.